Welcome back, folks. This is teaching 7 of 8 of the December 2016 content for the ICT mentorship. This teaching is going to be dealing specifically with momentum, divergence, phantoms, market maker trap. And I don't teach a lot about indicators because they're mathematically derived and they measure the past. As a new trader, I used them a lot and had a lot of false hope placed on them. I like looking at them at certain points in price action because I can see where I used to think price would go relative to a indicator, and I can tell you now it's a completely different paradigm shift. That when we see price action indicating that it wants to go higher, not looking at the indicator, many times the indicator is going to tell you it's probably stopping now, or it's petering out, it's making its reversal, or it's running out of momentum, if you will. The idea is the indicator is going to drive price. As a retail trader, that's what we think, and it's not the case. The indicators don't have any reflection whatsoever about what the market's going to do next. Price has no awareness of our indicators, but we can reverse engineer that thought process and use that market efficiency paradigm I've been teaching since the beginning of this mentorship, where we look at how liquidity can be either engineered or neutralized, and whether they're willing or unwilling participants, the market makers can draw traders into the marketplace or take them out of the marketplace. And by unseating them, they can assume their position or put them in on the wrong side by engineering liquidity runs and then take the market the opposite direction. In this case, what we're looking at here, this is the US CAD, this is the 1 hour chart. And I have the chart trained in on the November 10th and 11th. And we're looking at how the market made a slightly higher high here than here, while momentum was already posting a potential bearish divergence. Now, when we talk about divergence, there's two types of divergence. There's type 1 divergence, which is your classic higher high, but not seeing a higher high in the momentum. Okay, so that's type 1 bearish divergence. A bullish divergence would be the opposite, where we see a lower low in price, but a failure to go lower in the stochastic or whatever momentum indicator you use. That would be a type 1 bullish divergence. In trend trading or momentum trading, there's called a type 2 trend following, and it's commonly referred to as hidden divergence. And it's been never really associated to who discovered it, but Nick Van Nice, he was the guy that released it to the trading community at large. George Lane gets a lot of credit, and falsely, I might add. He was not the creator of stochastic. He's not the the inventor, if you will, of divergence. But nonetheless, it's one of those pet peeves of mine. I hate when I talk about this. I always got to bring it up because it's just like a stick in my craw. I can't stand it, so I have to keep reminding the folks that are in trading. If they talk about divergence, they probably should be thanking a guy that they'll probably never even meet, but his name is Nick Van Nice. And it's a trend following divergence, where if you have a higher low, but the stochastic cycles down, makes a lower low, that's trend following in nature, and it usually gives us a really good momentum entry for bullish markets. Now, I'm not teaching entries with stochastics or any momentum indicator here, but I am going to teach you how to use a means of sentiment, or how retail-minded traders are going to think about price. I like these ideas because when we read the books, when we get into trading, we get all these indicator-based books and textbooks and courses and CDs and mentors and everybody else and their disciplines. Okay, and believe me, I went through all this myself. So it's not like I completely, walk on water. I never had those issues before in the past. I came up through all that stuff. But the indicators teach us and they try to promote this idea that indicator-based trading is the way to go. So therefore, there shouldn't be no thought process involved at all about studying price. Just study if the indicator is overbought, if it's oversold, if it's diverging bearishly or bullishly, and that's it. So you have 4 conditions there. Are we overbought or are we oversold? And if we are overbought, is it diverging bearishly? Or if we're oversold, are we diverging bullishly? And if it were that easy, then everybody would be making money. The problem is there's some things you have to look at to determine if the market is in fact bullish or if it's bearish. And here's one for you. Here's a 5th condition. Is there really a time to be trading? Because there's some time there isn't. Markets will stay in consolidation, and you just don't want to be doing much of anything. So if we're looking at an example here, okay, where price makes a higher high like this, okay, forgetting what's over here, like a retail trader like I did, I just looked at, okay, well, now we're making a higher high here. So naturally, I'm just looking at any time when the indicator was failing to make a higher high. That's how I started in the business, folks. In 1992, I'm looking at charts, and this is what I'm looking at, a bearish divergence. Okay, so I would be looking to go short there in 1992 and 1993. But understanding what I know now, there's liquidity above this high. They're not going to keep price this close, okay, and not run that high. So there's buy stops above there. So if I see bearish divergence in here and it's qualified with this move here, we have a crossover. It starts to drop down, okay? But look what we have. We have a down candle here. We have equal lows in here. So the market drops down, clears out the equal lows, dips into this bullish order block. This also, in here, we have a range from the high down to the open on this candle. This range in price trades down into it, the midway point of it. Okay, just like a mean threshold. Okay, this portion, price comes down, delivers price below these lows in here. Momentum indicator folks are going to say, okay, well, this is a solid bearish divergence, so we're going to be expecting lower prices. Price action based traders are saying this is actually a buy, and there's an equal high up in here, and we have liquidity above this high here. We're too close to these levels up here not to run them. Market consolidates a little bit in here, and then boom, it rallies up, makes one more tap against this high here. Is price going to reject here? No. Look what's happened. We have a low, which is directly related to this cycle through on stochastic, and then we have this higher low with a lower low on stochastic. This is that hidden divergence or trend following divergence. Okay, this actually is a very powerful scenario if you know what you're looking for in price and you see this qualified in a momentum indicator. Not that you're basing your trade on the indicator, but I like seeing this because what this is doing is arm wrestling with the guys that are looking at this bearish divergence, looking to capture a high. Because think about what it is. When you're looking at indicators, the mythology is you can pick tops and bottoms with indicators. And while we can go back and look at the charts and see many examples how that may have been profitable, but there's many times where it isn't profitable either. So if we're going to be looking for price action to give us clues as to where price is going to be reaching for, you can't get that information by looking at an indicator, because all that's doing is looking at the past, and it's compressing all that data mathematically and spitting out an output. That output has absolutely zero bearing on where the actual orders are in the marketplace. UBS, Credit Suisse, Citi, they're not in the business of looking at what stochastics is telling them. That's not what they're doing. But they are interested in where buy stops and sell stops are. Okay, and they're attacking the liquidity on the fund level. So when I talk about making a run on stops, it's not that they're aiming for retail stops, because you're not even in the same arena with them. But if they can push price to an area above an old high or below an old low, they know that there's going to be a pool of liquidity in the base of fund trading. So let's recall that market efficiency paradigm. Retail views price and they see what they want to see in the context of an indicator. Buy or sell, overbought, oversold. Market makers look at the participants' thought processes about price and they manipulate their decisions based on what they should be seeing in price. The indicator's way of engineering a thought process behind a trader, it's almost like remote control in many instances. And funds, they trade with a trend following nature. They're long-term momentum trend followers. But those long-term trend following systems that they use can be targeted, and usually it's in consolidations, or sometimes if it's at a high where they're making a top in the marketplace, those funds that are aggressive and they try to sell short, they make one more pass up there and knock out those individuals. The smarter fund traders will go back in again, but you know what it's like sometimes when you get knocked out of a trade, the wind is taken out of your sails. You don't want to do it again. You're afraid. But when we look at divergence in here, okay, there's two camps. Those that see that higher high here and the subsequent movement lower, which would confirm in any retail trader's mind that they did capture a top, because that's what they're thinking. Okay, bearish divergence, they're looking for tops. Bullish divergence, they're looking for bottoms. You ask any trader that sees that, they're not looking at qualified entries and qualified exits and specific targets. What they're looking for is get me in at the low and I'll figure out where I'm going to get out later on. And believe me, I've done that same thing. When we look at price now, we see that, yes, they're going to see that as a bearish divergence. They're going to want to sell short. And we expect that same measure of retracement lower as well. But we want to see it come back down and hit this order block and wipe out this stops over here. Why would they want to come down below these lows in here? To gather up all the sell stops. Why? Because they're willing sellers down there. Why would they want to go down there? Because they want to pick up those orders that liquidity is offering so they can buy them. So price quickly reprices, and now we would make a run above this high here. Why? Because this is the real divergence, okay, or the new cycle low on the stochastic. Notice it's not oversold. It's not needed to be oversold. What we're doing is we're watching the momentum shift back down just to get the sell stops. Then they make a run for where the market really wants to be reaching for, the orders, not what this little indicator divergence is indicating here. So we're seeing retail view this as a higher high in price with a lower high in stochastics, which is what every textbook shows. That's a type 1 bearish divergence or a sell signal. Okay, you might have saw 30 pips or so in your favor, but you're not going to hold for just that. You're going to hold forever. You're going to look to see it go lower and lower and lower. You know what it's like to be, a new trader and looking at all this stuff. It's the same stuff you did just as well as I did. But if we wait for the stochastic to cycle down below this low here, we can anticipate that same thing occurring when it runs out some sell stops and it closes in a range for a bullish order block. Then we can expect price to snap back higher and take out this whole assumption that it's a bearish divergence in the marketplace. Again, price has no awareness of the divergence, but markets have an uncanny ability to be aware of the thought processes that are in all the traders because of their orders, because of their trading, because of their leverage, because of what they're doing in the marketplace, the excitement around specific levels. So when we see this, we anticipate price moving higher, not on the basis of bullish divergence that you would see classically with a lower low and a higher low in the momentum indicator. What we're actually seeing is a higher low relative to this low and here, this being higher low, but the momentum actually is cycled lower. Again, that's type 2 hidden divergence, bullish. It's trend following in nature, and we can expect to see price drop above this high here. And price does in fact that. So you can see price gave a nice opportunity here, and those individuals that looked for this bearish divergence were left holding the bag. Okay, folks, we're looking at the dollar Swiss. This is an hourly chart. Okay, we're looking at another scenario where the price has made a nice rally higher, and we're looking at what we potentially see as a type 1 bearish divergence. Now, again, retail traders are going to see that as well. We're making a higher high in price. So if price is making a higher high here, we're not seeing that same thing reflected here. the stochastic has crossed down, and now we have a signal confirming lower prices. So what we do as price action based traders, we anticipate seeing some measure of consolidation to retracement, and we watch this low back here on the stochastic, which is relative to this low here. What we're not seeing in our expectation is the move below that low. We're not expecting that. But retail is expecting that. They expect this to be a top and price trading all the way down to what would be seen as what? Classic support. They're looking over here at this low and maybe even a low back here. So in retail mindset, they're doing this. This is what's all over their charts. They're looking for a move down into this low, and they're looking for a move down into this low, because that's what classic support resistance tells us from the textbooks. This is what classic divergence tells us. They're going to catch a top. So the market's making higher high in here. From this high to here, we made higher high. It's not happening here in the stochastics. So if it's not happening in the stochastics, it has to be indicating that it's going to go lower. So they're looking for price to trade all the way down to this level here, and that might be their first target, and then here's their second target, because that's support and resistance. What we see is this is the last down candle prior to this up move. So inside this range in here, in this wick, we expect price to trade down into that. Now the question is going to be, Michael, do I use the high or do I use the body? You use the body. Why? Because of the condition that's here. We have a wick, and price has already traded several times through here. But we've only traded up from this point here. So this down close, we only had an up close, an up close, and up close. So we're going to be looking for price to trade down and deliver on the sell side of the liquidity on this candle's range. So what I'm saying is we're going to look at this candle here, encapsulate that whole little wick down into the opening. Okay. And we're expecting price to, yes, cycle down and go lower, but not to go below the middle of that body of that candle. So for a move down into 96.45 to 96.40 as a low end is expected. It's reasonable, but we do not expect that low to be violated. That same reference point down here in the stochastic is here. We expect the stochastic to trade lower than this low in the indicator, but not show it in price. We expect price to trade higher. Why? Why would I expect that to unfold? We have all this up here, all sell side liquidity offered, so we would be expecting price to be delivered on a move higher to close in that range. So we're looking for a difference in direction, and we're just going to use this old low. So we're going to use support and resistance ideas, but we're going to be diametrically opposed to what retail mindset's going to be. So we're looking up here after it drops down to here. So we're doing two things. We're bringing prognostication, we're forecasting, and we still have targeting. So we know what we're looking for entry. We are expecting, anticipating that market event to take place. We're going to go long around 96.45 with an exit around 97.08. Retail's thinking this is a top. It's selling off. It's going to break this low. It's going to make the low attempt to retest here and maybe even run down to here based on just an indicator. What we're looking for is, yes, the stochastic is going to drop down, as price should drop down, but the stochastic is going to drop below this low in the indicator. But it won't go below this low here because the institutional order flow is supporting higher prices, and they're going to want to close this range in. Okay, now watch what happens. Right there, this candle's low is 96.45. Look at the reaction there. Boom. Totally different from what retail would be expecting. Higher low to this low, lower low, and stochastic. Okay. This move here, not necessary. Don't worry about that one here. We're not talking about that now. I'm focusing primarily on where the divergence gets traders in a pickle. And it messes them up. In this case, we were looking for liquidity on the upside. Okay, and all I did was use a simple low back here. And if we use order block theory, that puts you up to here. And then you have equal highs up here as well. So 97.60, and then you have 97.28, and price blows through both of those. Okay, so that's an example of a few divergence phantoms where folks, like I did when I was a new trader, you go in, you're looking for scenarios to anticipate specific things to unfold, and the opposite happens. This move down here dips into this order block right here, clearing another area of sell stops, and then rallying. Ultimately, another bearish divergence here with a higher high. Is that a bullish move? I'm sorry, is that a bearish move? Is that a bearish move expected in here? Well, if you looked at the retail mindset, you have a bearish divergence. We're going to be expecting this low to not be violated, but the low in the stochastics will be. There you go, one more time. Type 2 trend following. Lower low in the stochastics with a higher low in price. Continuation on the upside. Another bearish divergence. This is probably the top now. It's got to eventually happen. Here's your bearish divergence. Okay. What happens? Price doesn't make a sell off as it goes higher, and it ultimately punches one more time up, and then it gives off a sell. So please don't think that indicators are going to be the answer. If you're learning what I'm teaching and you're getting still inspired to pull up indicators, only pull them up with this basis in mind. Only draw a contrasting view, and it'll give you what the retail minds are thinking. And if you can do that and also see reasons behind the scenes why institutional order flow is going to suggest the opposite occurring, chances are you probably got a good deal. Until next time, I wish you good luck. And